Good morning, Laura.
Hello, can you hear me okay?
I can hear you. Thank you
Excellent.
very much for stepping in to do this. We really appreciate it.
That's
So,
okay.
as usual, I'm going to let you sort of introduce the fund a bit first and tell us how it works, please.
Yeah. So Lowland, what is it? It's roughly 350 million market cap. Above that in terms of net assets, more like 420 million of net assets. All the reasons that Andrew was just talking about, really, that Lowland is at a bigger discount than it would normally be. The discount is around 12, sometimes touching 13 at the moment, whereas the long run average is more like 5, 6. So it is a bigger discount, and that means that the yield is also higher than it would normally be. So this is paying about a 5.1% dividend yield at the moment. We're not quite one of the dividend heroes. It's a long bugbear for this trust that we held our dividend flat during the financial crisis. So we're not one of the dividend heroes, but we haven't cut the dividend since the trust was launched, which is, I always forget, it was either 1962 or 1963. But anyway, we've never cut the dividend, and we try and make it very predictable for people, so we don't cut the quarterly dividend each time, so that people can effectively guess what the next dividend is. And what it so what is it? So it's a UK income trust. And what differentiates it versus most other UK income trusts is that rather than diversifying with income by going overseas, so often now, if you look at the top 10 or the top 20 of UK income trusts, you will see in there some overseas holdings, whether it's, often it's the likes of Microsoft, or it might be some of the big pharma companies. I saw Stellantis in one this morning, which is a car producer. We don't go overseas in Lowland. Instead, to diversify, we go down the market cap scale. So you can hopefully see the slide here, which shows that, so orange is us and grey is the benchmark. We have much more than the benchmark in the FTSE 250 and below. And we only have about 45% odd in the FTSE 100. The FTSE 100, because it has, as you mentioned, James, because it has done better than smaller companies, the FTSE 100 has now become 85 or 84% of the overall benchmark. The benchmark has become increasingly large cap, but Lowland is much more small cap. We go down the market cap scale. And the reason we do that, because people often sort of say to me, well, why aren't you either just a large cap income fund or a small cap income fund? Kind of why do you have both? Why do you sort of go across the whole market? And the reason is that we think the two elements of the portfolio, in other words, large cap and the smaller mid cap, bring something quite different. So the larger companies bring often more defensive characteristics. Think pharma companies, think utility companies, consumer staples. They're more stable. They tend to pay a higher dividend yield. And then the small and medium-sized companies these are companies at an earlier stage of their life cycle. They have a longer pathway of growth ahead. So they tend to bring faster sales growth, faster earnings growth, and therefore normally faster dividend growth as well, but from a lower dividend yields. And the two work, we think, well together as a blend within an overall portfolio, and they each bring something different. But, and I'm sort of cautioning this a bit, we have had more in the FTSE 100 over the last couple of years than we've had over the very long run. So over the very long run, we would have more like a third in the FTSE 100. And at the moment, it's more like 45. And the reason for that is partly passive, because, again, as I mentioned, larger companies have outperformed, particularly in that Ukraine year, where the natural resource companies, the Shells and BPs of the world, for obvious reasons, did very well. But it's also, we've kind of got there over a period of time, and I know this is going back a long time ago now, but when Jeremy Corbyn was head of the Labour Party, all of the utilities sold off because people thought he was going to nationalise them if he ever got into power. We bought quite a few of them then, and they all are larger companies. They sit within the 100. And then during COVID, when all the money got printed, we thought inflation was going to be a problem when we bought a lot of the banks. And again, they all happened to sit in the FTSE 100. So the FTSE 100 weight went up kind of in two leaps, if you like, over a period of a couple of years. But now we think the best value in the market is at the smaller end. And by the smaller end, I almost mean anything outside of the FTSE 20, which has now become, those top 20 companies in the UK are now 55% of the whole market. The Astras of the world have done so well that it feels to me like they're almost sort of squeezing out everything else. almost like what's happening in the States with, Meta, etc., but with clearly a different set of companies. But we think the value is outside of those biggest companies, and so we're moving the trust slowly down the market cap scale, and I can give you a couple of examples later. But it's those more domestic and smaller businesses where we think the best value is at the moment. If we just flick on, James, to the next one, I just wanted to touch very briefly on recent performance. So over the last, so this is the 6-month period, which only because we're in the middle of writing our 6-month report. But if you go back for the last 18 months or so now, Lowland has just about outperformed, and it is pretty modest. And the sort of dynamics of that are the wind has effectively been in our face in that smaller, medium-sized companies have underperformed. But then on the other side, we've had a level of takeover activity that I have never seen in 15 years in the city. I think we've got 6 companies that are under potential takeover offer at the moment. All of that is known and out in the market. The likes of, well, I guess just because it's on front of mind today, we've got the likes of Anglo American, but we've also had bids for things like IDS, which is Royal Mail, DS Smith, Hypnosis, which Andrew mentioned. And so what's happening is kind of the wind is in our face in as much as small and medium-sized companies are underperforming. But then at the other end, we've got takeovers happening, which is helping. And then there's also been the odd kind of what I would class as recovery share. So the likes of Rolls-Royce has been helpful. So those two things together have meant we've kind of managed to just about be neutral in it, or slightly better than neutral, in an environment where small and medium-sized companies, it has been very challenging, and it feels like sentiment towards the area is still pretty tough, and there have been outflows as well. So we're quite happy with that. And then in terms of income, I think I understand that it will be a focus for a lot of people. Maybe if we go to slide 7, this is the Lowland dividend over the very long term. And over this period, it's grown at about a 7% odd CAGR, but you can see that it's very clearly leveling off in the period after COVID, and sort of very gradually ticking up after that. And small and medium-sized company dividends got hit even worse than larger company dividends during COVID, because they do tend to be more, well, firstly, they're smaller businesses, obviously, but they're also more cyclical on average. So they were quicker to cut their dividend. And Lowland, until very recently, has been in a period of effectively growing back into the dividend that it already is paying. And those smaller company dividends have now come back. And last year, so this is the 2023 financial year, which is to the end of last September, the earnings per share for this trust was 6.7, and we paid out 6.25p in dividends. So we are now back covering that dividend, which, as I mentioned at the beginning, is now about a 5.2% yield. I wanted to give a bit more colour about dividends, though, because I think there's quite an interesting trend that we're seeing in the UK market at the moment. And this isn't just for this trust, this is more broadly, which is that special dividends are almost disappearing from the market. And the reason for that is that the marginal buyer of shares in the UK is increasingly US shareholders. And share buybacks have been a big, as we all know, share buybacks have been a big distribution mechanism in the US for a long time, but hasn't been so big here in the UK and in Europe. But the marginal buyer of the shares is a US shareholder that is turning up to these company management meetings and saying, I don't want you to do a special dividend, I want you to do a buyback. And if you're a company and you have this buyer that's telling you to not do that special dividend, whereas the UK shareholder probably is in outflows, and you're more likely to listen to that US shareholder and go, okay, well, I will do a buyback then. And you're probably also feeling a bit irritated if you're a UK management team at the valuation that your shares are on. So what we're seeing is those special dividends going and being replaced by buybacks. And at the same time, so many companies cut their dividend during COVID that they don't have a long dividend history anymore. So whereas the UK market, historically, there was such an entrenched dividend culture, and companies would try their absolute hardest not to cut their dividends. So even if their earnings fell, they would try very hard not to ruin that very long dividend track record that they had. Whereas now they've only got a dividend track record that's probably 3 years or so. So if you have a payout ratio that's 50%, say you're a company like Marshalls and you're building materials and it's a tough end market at the moment and your earnings have fallen and you've got a payout ratio, increasingly you're just going to stick to that payout ratio. So you will just cut your dividend and you will not pay as much attention to that dividend history because, as I said, it's probably only a couple of years. So what does all this mean? As a trust, as an investment trust, I think it's fine. And if anything, it's an advantage. We have a small revenue reserve. We have hundreds of millions of capital reserves that we can dip into. We just need to make sure that the board understands this dynamic, that shareholders understand this dynamic, and that's fine. And I think we can keep going. But if you're an open-ended fund and you're paying out everything that you get in any given quarter, I think what you're going to see is more volatility in terms of the dividends. So if you want predictability of income, I think that's quite a strong story in favor of investment trusts that as an income vehicle. But I just think there's a different dynamic for UK dividends from now on that it's just worth being aware of. And if so, moving on to valuation, as I mentioned right at the beginning, Lowland as a trust is at a bigger discount than it would normally be, sort of 12, 13. But there's that valuation discount, but then there's also the valuation discount at the portfolio level. You mentioned, James, the Aberforth valuation right at the beginning. We're not quite at that level of valuation. This portfolio is more like 10 times historic earnings, and the long run average would be more like 13. What I quite like about that number, that 10 times, is that it is historic, so you can't debate it. I guess the question in the UK market is always, well, could you see a step down in earnings because the economy is not doing brilliantly? That is just a historic number. And I actually think there's quite a lot of earnings rebasing that's already happened within that 10 times number. So going back to a company like Marshalls, which is it's just paving slabs, roofing, that kind of thing. They've had earnings fall about 50% roughly within the last year or so. That is already within that 10 times number. So the way, and I'm sorry if I sound kind of over optimistic, but the way I sort of see what might happen in a couple of years, and we can never put kind of an exact timing on these things, is that there's a potential for some of these UK domestic businesses in particular where you could get an earnings recovery if the UK economy does a bit better, and a rating recovery. And those two things, if they could happen at a similar time, you get a compounding effect. So you get the earnings recovery, and then people feel more confident, and you also get a valuation recovery. We can never say, and this is an if, obviously, we can never guarantee anything, but that's quite powerful when those things happen together. And then if you wanted to be really, really optimistic, you could say, well, the trust is also at a discount. I heard Nick Greenwood from Premier Miton describe the UK sort of smaller companies sector as a Russian doll in terms of the levels of discounts that you get in. And I thought, yeah, I'm going to nick that. That's a great way of putting it. But it genuinely is that there's multiple layers of discount once you get to the smaller cap end of the UK market at the moment. And I'm just going to name a few companies on slide 9 if we flick over, James. This is only a couple. For Lowland, we've got just over 100 holdings, so it's not a concentrated fund, but just to sort of name a few. We have been adding to some property names, so the likes of Shaftesbury Capital, which is property over in the West End. It's got stuff like Carnaby Street and that kind of thing. It's mixed use. And the likes of Workspace, which is flexible use. It's almost like WeWork, but it's a completely different business model in that they own the assets, but it is shorter lease office buildings. And both of those companies would be trading at substantial discounts to NAV, and yet both, I think, have good prospects in terms of rental growth. So particularly Shaftesbury, just you cannot replicate the assets that Shaftesbury has in the West End. And anyone that's been out in that area of London recently, I don't get to go often, I have very small children, but anyone that has got to go out recently will see that area of London is really, really buzzing and doing very well. And then the likes of, we've also added to some specialty services business, so something like FRP is restructuring largely. You could argue that they're a beneficiary of higher rates because it is pushing more companies, unfortunately, into administration, and FRP does the work for some of that. And then the likes of XPS Pensions, which is a specialist pensions consultancy business. These are the types of smaller companies that Lowland is going after at the moment. I'm going to stop there, but I think if we put up slide 10, which is the portfolio, then if anyone wants to ask questions about specific, well, this is just the top 20, but if anyone wants to ask more portfolio specific questions, we can have that up there.
Thank you very much, Laura. That's really good. Really interesting, actually. I mean, I actually just briefly, just to go back to that dividend thing. It is daft that you're not a dividend hero, really. I know you see the sort of pause there, really, and every other. Yeah, there we go.
Those are the rules.
There's the rules. Yeah, exactly. Okay, so probably better to think about sort of the big picture first, if you don't mind. So, can you think where there might be catalysts for a re-rating of the UK market?
My number one question that I get in every client meeting. I suppose at the moment the catalyst is definitely takeovers, and I mean it when I say I haven't seen anything like it. It is every week, and I'm really not. I'm genuinely not exaggerating. It's every week at the moment that we're getting a bid coming in. You know, that is the catalyst in that performance has been a bit better, but it's you know, the reason I sound a bit reticent about that is that I do find it worrying how many companies are being taken over. And we haven't got anything sort of coming in the other side at the moment. Hopefully that will change. So that's the catalyst right now. I think as I kind of look ahead to later in the year, I think you know, this is just my view, other people would disagree, but I think Bank of England should just get on with cutting rates. I think the UK economy is in a different place to the States. So this kind of almost obsessive fascination with what the US economy is doing, and you can see it moving the UK market. I just don't get it. You know, the UK economy is in a different place to the States. I think the Bank of England should just, you know, cut rates, and I think that will prove a catalyst. Well, it could prove a catalyst, because I feel like we just need a bit of momentum for some of these smaller companies. Again, if you talk to the likes of Marshalls, they really need the house builders to be building more housing again to get the demand going for that type of product. And I think realistically, in order for that to happen, we probably need an interest rate cut. So that could prove a catalyst, you know, if it comes later. And again, you know, we could argue it might be June, it might be August, it might be later. But I think that could prove a catalyst when it happens. I do think, though, I mean, I know I've just given you a couple of catalysts, but I do think trying to think of a catalyst is, if I'm being really honest, a bit of a waste of time, because I think people always, you know, after the event go, oh, that was the catalyst. And you think, oh, really? You know.
Fair enough. The takeovers that we are seeing, are they coming at fair prices, or are things being sort of taken out cheaply?
It's a real mix. What I'm tending to find is that if it's private equity, I tend to find the valuations a bit stingy, if I'm being honest. Whereas if it's a peer company coming in, then there are normally costs that can be taken out, and you get to benefit from some of that as shareholders. So to give you an example, something like Devro, which we had taken over last year, which makes sausage casings, very Lowland, that company, that was taken over by a European peer. And when I saw the bid come in, I thought, yeah, that's a fair valuation. You know, for that type of business, it wasn't a particularly, you know, it's a perfectly good company, but it shouldn't, you know, shouldn't trade on 20 times earnings kind of thing. So when that bid came in, I thought that was fair. Whereas, you know, we've had some others. I'm trying to think about some of the worst ones. Something like Finsbury Food, which makes cakes and bread and that kind of stuff. Again, it shouldn't be a 20 times multiple business, but it got taken over by private equity. I'm going to say it was something like 10 or 11 times earnings. Anyway, it was a very low multiple for a well-invested business with a good balance sheet, really solid management team, and that kind of thing. I felt quite aggrieved by. So it just really depends. Some of them are at valuations that are perfectly fair, and some of them I don't think are.
Obviously, that's freeing up cash. I mean, there's a question about DS Smith, and I guess, you know, if you get a sort of largest position taken out, you then got to reinvest it. So have you got a sort of long pipeline of potential investments, or would you just add it to the existing portfolio? How would it work?
I'm sort of building up our list at the moment, because you're right. If you know, if we had all 6 of these go through, and they probably won't all go through, but say that, we've got quite a lot of cash that we'll need to reinvest. At the moment, we're not struggling for ideas. So we've bought, for example, something like, I honestly never know how you say it, Dowlace. Anyway, the old GKN that came out of Melrose, it's a relatively new listing within the last year, 18 months. We've bought that. We owned GKN actually a long time ago before it got taken over by Melrose. We're effectively buying it back, but now it's just an auto supplier. The aerospace bit is still with Melrose. Something like that has traded very, very poorly since IPO because the people that inherited it were Melrose shareholders and effectively didn't really want it, and it's gone through this period of sort of shareholder register dislocation. So we've bought a new position in that. We've bought a relatively new position in Smith and Nephew, which is medical devices. Again, it's been a pretty poor performer, sort of huge discount to some of the US peers. So we've got quite a long list of things that we're happy to buy. So at the moment, I'm not worried about it in terms of the UK market sort of slowly disappearing, but I mean, I definitely wouldn't want to see it carry on at this pace. I'm just hoping that this level of takeover activity gives a jolt to asset allocators, maybe the government, I don't know, because we wouldn't want to see it carry on like this. I mean, it's helpful for short-term performance, but it's not a particularly healthy dynamic.
When you are looking at new investments, is there a kind of yield target in mind? Are you constantly trying to improve the revenue of the portfolio, or is it just a mix of total return kind of objective?
Not hugely. I mean, we're not an income fund that says, look, every stock has to pay above a 4% yield or whatever it is. I think I tend to look for companies that are generating cash. Do you pay probably at least a 2.5% type yield? But I think we've got to be careful in that it's often the lower yield companies that are proving to be the best performers at the moment. So if you look at something like Rolls, that's been the biggest contributor for Lowland over the last year or so. And that, I mean, it might return to paying a dividend maybe later this year, but it pays no dividend at all at the moment. So I don't think we should be too rigid on looking for yield. And again, I think it's great to be an investment trust in that world where we don't, we just have a bit more flexibility on that than an open-ended equivalent would.
Obviously, it's great that the dividends covered this year, last year. How important is it that the dividends covered going forward? Because obviously there are some funds out there that consistently pay out of capital.
Yeah, I mean, I maybe have an old-fashioned view on this, so some might disagree, but we did pay an uncovered dividend during COVID, and I think sometimes people misunderstand the revenue reserve. The revenue reserve isn't a pot of cash somewhere that you can just dip into. If you're paying out of capital, as we did during COVID, given what happened with the dividends, you are finding that cash from somewhere, as in you are selling parts of your portfolio to pay that dividend. And that, to me, that works if you are going through a period where your NAV is growing strongly. If you're going through a tougher period, that really felt challenging. We were during that period where share prices had already been hit badly. We were going through thinking we need to sell something, and I wouldn't want to be doing that on a more long-term basis. Now, it was the right decision because we're back and we are covering the dividend, but I really wouldn't want to do that every year. The way I see it is that we should be covering it on an average basis. I won't worry too much if in any one year we don't quite cover it, but I wouldn't want to do that on a sustained basis.
Yeah, fair enough. Thank you. There's a couple of questions about specific investments you've done. Well, one is about the sale of AstraZeneca. Can you talk us through the thinking behind that, please? And also your purchase of Vanquis Banking.
Okay, so let's do Astra first. Astra has been, well, firstly, let me say it's been a mistake to sell it. I mean, it's been a phenomenal performer. Pascal has done a really brilliant job of turning around that business. It's very rare to see that type of turnaround from the cheapest in the sector to among the most expensive over sort of whatever it is, 15-year horizon now. I think it's hard to keep repeating the trick in pharma. It's an unusual business in this respect that, it's not like Diageo or something where you've got brands that effectively have as long as you keep them ticking over, almost a sort of permanent life cycle. Whereas in pharma, things do just go off patent and you lose them. And as the company gets bigger, it's now a 50 billion or top line at Astra. You have to keep finding bigger and bigger and bigger drugs to keep the momentum going. And Pascal has done a fantastic job of doing that so far, but that does get trickier and trickier as you get bigger. And the shares are trading at a valuation premium to the rest of the sector. So sort of implying that they can keep doing that. And they might, and they've had some brilliant success stories within it. But I think that will become increasingly challenging. Whereas we do hold Glaxo, GSK, that's trading on a much lower valuation. Sentiment is very different at GSK than it is at Astra. Where GSK does have leading franchises in some areas like HIV and in types of vaccines. So we have a preference for GSK, but I don't want to deny that Astra has been phenomenally successful. In terms of Vanquis, it's not a new holding. It's been there as Provident for as long as I have been involved in this trust, and I think it was held long before that. It has been a big mistake. It's been a period. It's a company where it almost seems to have been in turnaround for probably coming up to 10 years now under various different management teams. And most recently, it has had consumer complaints from one sort of claims management company that has meant costs have spiked up completely unexpectedly, not the fault of the very new management team. The valuation is very low. It's a small holding now. It's about 0.5%. I think my view is that it's too risky to add to at this point, but it's also very lowly valued, and that's reflected in the fact that it's a pretty small holding at this point.
Fair enough, thank you. Can you tell us about gearing and how you use gearing within the portfolio?
Sure, the gearing's about 12-13% at the moment. That's roughly in line with where it's been historically. Our view is that gearing is, along with the revenue reserve and things, is a big advantage of the investment trust structure. So we want to use it. And particularly at times when we think valuations are attractive, which is definitely where we think we are now, we would only, I think market timing is not we're not trying to fool the market is what I'm getting at. So unless we have a very strong view that valuations are expensive, which James did have going up to the financial crisis, sort of to his credit, so he took it to net cash at that point. It's pretty unusual that Lowland would have anywhere near net cash. We tend to just keep it there, thinking that this is an advantage. We'll be able to do better with the dividend and capital than we can. It should be comfortably above the cost of borrowing. So gearing is almost structural in this trust.
Yeah, fair enough. I think it makes sense, really. Politics. I mean, obviously, I suppose given what's going on today, do you think a change of government's going to have any difference, make a difference to the UK market?
Maybe controversially, I think it might be quite helpful. When you talk to, we obviously meet a lot of management teams. When you talk to them, they tend to say very well. Maybe they would say this, but they tend to say very good things about the shadow cabinet, the engagement that they've had. I think it would be, if I'm being honest, sometimes it feels that you almost need a change to get things done. Let me give one specific example. So a company like IDS, in other words, Royal Mail, we do probably need to change the universal service obligation. And I think Ofcom understand that, but it feels like there's almost this sort of stalemate until after the election, which is frustrating because they should, they could just get on with it and do it now. But there's a couple of areas like that where you feel you almost need the change to happen for things to get going. I think with things like the house building volumes, again, you might need to get the other side of an election before you really see that pick up again. So I'm looking forward to us being on the other side of it, actually.
Yeah. one question on here. I'm intrigued. How do you split the job between you and James?
There's no sort of formal split. If I was to very roughly summarize, James tends to do the smaller end more, and I tend to do mid and large more. But that makes it sound more formal than it is in reality. And there are smaller companies that I would follow very closely, and larger companies that he would follow very closely. But very roughly, that's how we tend to do it.
Yeah, that makes sense. Thank you. Cool. And then I suppose the last question on here is really about the discount. Do you think that's just a question of narrowing it with performance or buybacks, or how do you think the best way to tackle that is?
I think it probably has to come through a combination of performance and also sentiment. The way Lowland tends to trade is it almost trades as a proxy between UK income where it sits and UK smaller companies, because people know that we do have a sizable smaller company element in there. So the discount it looks an anomaly compared to its UK income peers, but it also tends to trade with UK smaller companies where discounts are generally quite wide at the moment. I think for it to come in, it probably needs, it definitely, performance is always pretty crucial to these things. It definitely needs that, but I also think it probably needs better sentiment towards the UK more generally, which tends to impact smaller companies more. I think it needs a combination of those things.
But of course, now it's still part of the attraction, as we've explained, for the many layers of discounts. Thank you very much for doing this morning, Laura. It's been really interesting.
Thanks for having me.
We'll get you back again in a year or so and see how it's been going. But thank you.
Thanks.
So we will be back next week talking to Richard Pinder of Literacy Capital. And we have a full lineup, as we've explained before. So have a good weekend, long weekend, and I will see you next Friday. Thank you.